Hey, it's Tom here and welcome back to the channel. I'm in a slightly different setup to where I usually film my YouTube videos, but I'm hoping that the audio and video quality is still coming through okay. So as you've probably seen by the title, this is a Q&A video. I put up a community post here on YouTube yesterday asking for your questions for this video, and I'm going to work through some of them today. So we've got some really good questions. We also have the news this morning, and there's been a couple of questions come through around that about Charlie Munger through the Daily Journal Corporation actually selling about half of his Alibaba stock. So big news there, and we'll be definitely getting to a couple of questions on that in this video. And as always, if you want to ask a question in a future Q&A video, make sure that you've got notifications turned on for the Investing with Tom YouTube channel. You should then see whenever I put up a new community post, and you can get in there quick and ask your questions. So I'm going to start off with a couple of the kind of top rated comments and questions on this community post. We'll also answer the question around basically my thoughts on what's happening with Charlie Munger and his sale of Alibaba. And then I will basically just work from the bottom up, so from the people who got in and asked a question really quickly on the post, and just kind of go from there. So without further ado, let's get straight into it. So first question here is from Ganesh S. Hey Tom, would you be willing to make a series explaining the peculiarities and the economics of the industries / businesses that are within your circle of competence? Yeah, for sure. I mean, it's going to be a relatively small number of industries and businesses that I can make a video like that on, or that I feel like I know the industries well enough to make some dedicated YouTube videos on that. But certainly if you're keen to see that type of content, let me know in the comments below. I think I could do a pretty good job of like sort of agricultural and food production type businesses, and perhaps some businesses and commodity producers that kind of touch that industry. So maybe like fertilizer businesses or general sort of commodity producers, I feel like I'm reasonably comfortable with. With a few exceptions, I'm certainly not like an oil or natural gas expert or anything like that, but I feel like I understand a few of those agriculture focused commodities pretty well. Also have spent a bit of time studying the automotive industry, so feel like I know that reasonably well. And I'm not bad on a few of the kind of consumer products and technology type businesses. So the Apples and Microsofts, Facebooks, Googles of the world, those types of companies. So yeah, if you're interested in seeing that type of content, let me know down in the comments below, and more than happy to make some videos on some of those industries. So next question is from Luca. What do you think about the magic formula or the Everest formula, not to apply these strategies, but to create a first list of good and undervalued companies to analyze more in depth? Yeah, I think that's a pretty reasonable way to go, to be honest. I can't say that I'm that familiar with the Everest formula, but certainly familiar with the magic formula that basically ranks stocks on two different metrics. So an earnings yield, which is just a proxy for cheapness, basically. So if a company has a low PE ratio or a high earnings yield, in other words, it looks more cheap, all other things being equal. And it also looks at, I believe, a return on capital or return on invested capital metric, which is a proxy for business quality. So if you can find businesses that are cheaper than average and higher quality than average, that's certainly not a bad place to start. I also sometimes take a look at the acquirers multiple screen from Toby Carlyle, which basically throws out the business quality component, but will give you just the absolute kind of cheaper stocks on a EV/EBIT multiple, I believe is what the acquirers multiple is. So yeah, I think it's certainly a good place to start. A couple things to keep in mind. The main one is that things like the magic formula or the acquirers multiple typically are just looking at the last 12 months. So you can run into situations where basically almost all the companies from an entire industry will suddenly show up on the screen, because that industry might be having an exceptionally good year, earning a lot of money, so they have much higher returns on capital than usual. Even though they might still be rationally priced, they may have a very low PE ratio because people expect those earnings to come back down to earth over time. So there are some things to kind of just keep in mind as you hunt through those the companies that show up on those screens, but it's definitely not a bad place to start looking. And I mean, A company like HP has been on the magic formula screen for quite a while. I think it might still even be on there now. And we've just seen, Buffett's Berkshire Hathaway buy a big stake in HP. So you can certainly find some interesting investment opportunities in those places. So let's do one more of these kind of top-rated questions, and then we'll touch on Alibaba and then just get into people who jumped onto this post most quickly. So we've got a question from Just One, which is kind of funny because you've asked 2 questions, but Just One says, thanks, Tom, for everything you put out there. No problem at all. And 2 questions for me. 1, how do you go about determining competitive landscape and where the company you are interested in fits into it? And 2, have you written down your thesis on Thor privately? I guess the question is more general. Do you write down theses on companies that you invest in? So on the first one, with some businesses, I find the competitive landscape very straightforward to analyze. Take a company like Apple, for example. Their moats to me, or competitive advantages to me, are fairly clear. They have a brand which allows them to charge a premium, and they have kind of this sticky Apple ecosystem which makes it more difficult for customers to switch to Android or some competitor. So sometimes it's straightforward, other times it's much more difficult. So I've really been struggling, honestly, with trying to get my head around competitive landscape for something like Naked Wines recently. In that situation, I think probably the best thing to do is to go out and read annual reports and that sort of thing from competitors if they are publicly listed, bearing in mind a lot of competitors won't necessarily be public companies and you might not be able to get the full kind of financial reporting on them. But if you can do that, that's a good way to go. And the other thing that I tend to do is just try and put myself in the customer's shoes. If I were looking to purchase wine online, for example, in the case of Naked Wines, what are my options? What is the best quality? What's the best price? What has the cheapest shipping? Maybe there's some other stuff you might consider as a customer as well. And if it's very clear to you that you have a strong preference for one particular company in that industry, then that should tell you a little bit about their moat or their competitive advantage. And if you find it more difficult to make a decision and they kind of just all look equally good, maybe that tells you that there's a lot more competition in that industry and it's going to be hard to kind of be really dominant. Okay, so let's spend a couple of minutes talking Charlie Munger and Daily Journal selling Alibaba. So if you don't know already, Charlie Munger runs the portfolio for a public company called Daily Journal Corporation, and that is where basically Charlie Munger has been purchasing Alibaba. So whenever you see videos on YouTube saying, Charlie Munger just doubled down on Alibaba or just sold Alibaba or whatever, that's what people are referring to. So we've got a couple of questions on that. I'll just take this one from Sten Hemming. What do you think now about Baba when Charlie Munger sold? I try to stay rational and remind myself that there is no way to know why and stick to my own thesis, but it's hard. Yeah, for sure. I mean, that's kind of one of the problems with the shameless cloning, I guess. Obviously, I run the shameless cloner portfolio on the channel, but that isn't real money. That's largely experimental. But I really like, cloning super investors in terms of getting investment ideas. But you do start to run into these sorts of issues if you're just kind of blindly cloning people, I would say. If you have 2 super investors go into a stock like Alibaba, take Charlie Munger and Mohnish Pabrai, for example, and then Mohnish Pabrai sells, you've got to make a decision on which person do you clone. Do you keep cloning Pabrai? Do you keep cloning Charlie Munger? Do you clone Guy Spear, who's just kind of sitting on it? And, if you don't have your own investment thesis around some of these companies, it can be really tricky. I guess if you're just mechanically cloning, then it kind of is what it is, and you have to have rules about that. But I think you've certainly got to build your own investment thesis. So in terms of what's happened with Munger, I'll put a screenshot up here. So he's basically sold 50% of his Alibaba stock. We got an early 13F from Daily Journal. And it's kind of hard to say why. I think there's a few potential reasons. A few that are kind of getting thrown around would be he's converted to Hong Kong listed shares. I don't think that's that likely personally, given the fact that he has, talked about, having a derivative ownership of Alibaba through the VIE in the Cayman Islands. He's talked openly about that and said, as long as there's honour among civilized nations, he doesn't view that as a particularly large risk, but that is a possibility potentially. Other things is his thesis has changed and he thinks he's wrong. It surprises me that he would only have sold half if that was the case. I would have thought that he'd just sell the whole thing and kind of cut his losses at that, but that's a possibility as well. And then potentially tax loss harvesting. We saw, obviously, Monish Pabrai tax loss harvest on Alibaba and then roll the proceeds into Persist to get a discounted ownership of 10%. So perhaps Munger's done something similar there. We don't really know. And maybe the final possibility, I guess, would be that Charlie's got some sort of margin call. So Daily Journal does use a little bit of margin. I'll put a screenshot up again here, but I believe that's around $35 million from memory. I would struggle to believe that it's related to a margin call. The only reason I say that is because if it was purely a margin call, or if it was purely margin just on the Alibaba holding, sure, Alibaba's down a lot and you can't be that surprised that Munger might get a margin call. But if you put it in the broader context of the overall Daily Journal portfolio, the margin isn't that significant. I'll again have the margin loan amount here. I think it's around $30 million or so, and I'll compare that to the overall kind of stock portfolio at Daily Journal, which is much greater than 30 million. So I would be surprised if it's a margin call, but yeah, I really don't know why Munger has sold it. It is somewhat surprising to see that. I suspect there'll be a lot of questions submitted on that topic at the Berkshire Hathaway annual meeting coming up soon. Whether they'll actually get asked to Charlie and whether he'll be open and answering them, I'm not sure, but yeah, pretty fascinating move there from Charlie. Okay, so I'm going to go now to some of the people who just asked questions very quickly on the post. So the very first one we have there is from Dimitri D. Why is Thor diluting stock and also paying dividends? That seems odd to me about Thor actually here. This could be an indicator to looking for short candidates, very successful short sellers. Look at any business that sells both equity, raises capital via equity sells, and also pays big dividends. There is something horrible in there. Yeah, I must say I disagree strongly on something horrible being in there. Again, I'll just put up the stats here so you can see it. This is what the shares outstanding looks like over time for Thor. There were about 2% a year, I think, in 2018 or 2019, something like that. Share dilution. Again, it'll be up on the screen here, so you should be looking at that. But that was actually to do with an acquisition they did of the Erwin Group. That was a huge acquisition relative to Thor's market cap at the time. It was mostly funded by cash that was on the balance sheet and also some new debt that they took on. But there was a small component, I think approximately about 10% of the acquisition costs that came from raising equity. So if you're wondering what's going on there and what happened in those couple of years, that is what it was. They really do not use a huge amount of stock options with their compensation packages for management. Largely the compensation is just straight cash and cash bonuses, so I don't expect we'll see a lot of dilution from that. And they're just starting to buy back shares. So the market cap for Thor is in kind of the $4 billion or so range, and Thor have just authorized about $250 million in share buybacks. So I expect the shares outstanding will be likely to come down over time. And you've got a very big owner in Peter Orthwein. He's chair of the board. He's one of the founders of Thor's, has about $100 million or so invested in the company, and he will be certainly keeping an eye on capital management extremely closely, because that's obviously very material amounts of his net worth. So yeah, that's my thoughts on what's going on there with Thor. All right, we've got another question from Eighth Wonder Investing. What do you think of Naked Wines and RGA write-up? Can someone else come in and compete easily and recreate their moat? Possible investment, will you be putting out some wine content? Thanks. Yeah, I must say I've gone a little cold on the Naked Wines front. I think the questions you've asked here are basically the ones that I still have. So what does a competitive landscape look like, and can a Costco or someone come in and disrupt the moat and disrupt the Naked Wines business. So I'm not sure if I feel as though I've got something I can really add on that topic, I will make some more Naked Wines content, but that's kind of where I'm at with it for now. Our next question here is from Indian Freestylers. Thoughts on value investing still persists or not? Can we find actual bargains in the markets correlating quality considered buy for long term? Okay. Hopefully I can make sense of your question here. In terms of value investing persisting, most certainly. I think value investing will be around several hundred years from today, most likely. I mean, value investing, at least my interpretation of it, is just trying to buy something for less than it's fundamentally worth. You look at the cash a business will produce over time, or any cash producing asset for that matter, whether it's real estate or a bond or whatever. You look at the cash that will produce over time, how confident are you that cash will appear, and what's the price? And I don't think that way of value in businesses, or that style of value in businesses, is going anywhere anytime soon. I think there is definitely more competition. Reading The Snowball under here from Alice Schroeder about Warren Buffett's early career, it was just kind of crazy how inefficient some of the pricing was in the market at that time, and a lot of those opportunities have disappeared. People are picking up the $100 bills off the floor, and things are probably priced more efficiently, but I don't think that means there are no opportunities left. So thanks for your question there. Next one's from Jeremy. Thoughts on Porsche VW value arbitrage with Porsche brand spin-off planned for Q4? Is this another Fiat/Ferrari opportunity? I must say I have never looked into that situation, but that question is prompting me to do so, because the Fiat Chrysler Ferrari spin-off was exceptionally successful. I believe Guy Spears still has that big chunk of Ferrari sitting in his portfolio, which he effectively didn't pay for because it was just buried in Fiat Chrysler when he invested in it in 2012, I think that was. So, I'd be interested to take a look at that one for sure. Next one is from J. Sawyer Financial. Which sector do you think will outperform over the next decade? That's a really tough one. I have enough trouble trying to understand individual businesses, let alone entire sectors. I think there's a couple of ways to look at that. I guess outperformance will be a function of kind of movements in valuation multiples. So if there's an industry that has a very low multiple today and will have a higher multiple in the future, that is obviously a tailwind for outperformance. And then there's underlying business growth as well. So I think the valuation multiple part of that equation is much, much harder to put hard numbers on, obviously. You can buy at low multiples, and that gives you some protection from adverse multiple change happening to you, multiple compression, but there's not a huge amount you can do about that really, besides not massively overpaying. So I would focus more on businesses that will have a lot of underlying, or focus on sectors that have a lot of underlying business growth. And I don't really have any that particularly spring to mind super quickly. Things like e-commerce and cloud are kind of obvious candidates in that front. But I'm sure there's plenty out there that I'm just not thinking of right now. So if you can find those industry tailwinds and acquire businesses at reasonable prices, that is certainly a very helpful way to go. So appreciate your question. Next one is from Dubious Reginald. Got any new podcast guests that are coming up that you're excited to record with? I have a couple of podcast guests that I'm very excited to record with. We're currently in the process of planning out some podcast episodes for the Omaha trip, Omaha, Nebraska. I'm going to the Berkshire meeting, if you hadn't heard that already, with Brandon from the New Money YouTube channel, and also Hamish Hodder from the Hamish Hodder YouTube channel. And we're trying to line up as many podcasts as we can with some cool guests over there to do a few more in-person podcasts. So that will be exciting, and I think we're planning to do some sort of preview podcast before we go on that trip with the three of us as well. So that should also be fun. Okay, and let's take a couple more questions and then we will wrap this video up. So next one is from Ankrath WB. What's your bull case for Daily Journal Corporation? Yeah, so that's an interesting question following what's just happened with the Alibaba position. But I would direct you to Matthew Peterson's work. He's done a whole lot more research on Daily Journal than I have. But long story short, there is a very large stock portfolio component to DJCO. There's also a dire newspaper business component to DJCO, which I believe Matt Peterson basically just values at zero. And then there is also quite a sticky, basically court software as a service business embedded in DJCO as well. And in Matt's view, at least, you're effectively buying that software as a service business that should generate a lot of cash flow at a very reasonable price if you factor in the stock portfolio that you're getting when you basically buy DJCO shares. So that's the bull case. It's in the Shameless Cloner portfolio that I run on the channel, but I don't own it personally. I would definitely direct you to some of Matt's work to get into a bit more detail on that. And let's do one last question, because this is a bit of a fun one, from James Peets, which is, why do you hate Sky TV NZ so much, Tom? And be gentle, please. It's my largest holding. Yeah, that's a really interesting one. I don't have a position in Sky TV. If you caught our punch card stream a couple of weeks ago, which was our April Fool's weekend video, I was actually planning to talk about Sky TV as a April Fool's joke investment that I was talking about. And then Frank Tabor was actually messaging me in our group chat and saying, Tom, that's actually a really interesting investment case. They've got this huge free cash flow yield and they're paying a lot out as dividends, and I think some share repurchases, but I'd have to check that. James, you probably know what's going on there better than me. So I very quickly turned around and said, maybe I'd better not actually make a kind of joke video about investing in Sky TV. So I don't hate Sky TV. I have no position in it. I think maybe they're just an easy target, and they've had a few rough years, and I've taken a few stabs at them possibly. But James, I hope that investment works out very well for you. So that's really all the questions we've got time for on this video, so I'll wrap this one up there, but appreciate everyone who asked a question. Like I say, if you want to ask a question in a future Q&A video, just keep an eye out on my community posts page here on YouTube. Turn your post notifications on for the channel and you should be able to see that. But that's it from me for this one, and I'll see you in the next video. Cheers.